The Singapore corporate income tax is a flat 17% of the company's chargeable income. While this is one of the most competitive corporate tax rates in the world, corporate income tax still remains the top revenue contributor to the government. And much like our personal income tax, there are a number of ways you can reduce your corporate income tax, legally of course. So, in this video, I'll be sharing 8 things your business can do to reduce its corporate income tax. Also, this video was produced in collaboration with Osome, but more on that later. First up, here's a super simplified explanation of how the Singapore corporate tax system works. Here, we have a financial statement that I got from Singapore Airlines, also known as the best airline in the world. So, whatever money the company brings in is called revenue. However, rather than directly taxing this revenue directly, the company can first deduct away the business expenses that they have incurred. Though, take note that not all business expenses are tax deductible. In order for an expense to be tax deductible, it needs to be solely incurred to produce income, such as staff costs, maintenance fee, commissions, rentals, advertising and sales costs, and so on. While non-deductible expenses are personal expenses, like you take Grab to eat dinner with your girlfriend, you go Japan with your family, or you buy new clothes for yourself at Uniqlo, are all non-tax deductible. Also, capital expenses such as purchase of fixed assets, renovation costs, and startup expenses like license fee, registration fee, and signboard are non-tax deductible. Then, once you have deducted away all the expenditures, whatever that's left over will then be your profit before taxation. Some call it before income tax, some call it chargeable income, some call it taxable income, but they are all the same thing. This is the amount that will be subjected to the 17% corporate tax. Though, in this example, it isn't exactly 17%, as SIA is also subjected to income taxes in various jurisdictions, and there's deferred taxation involved. So, with that in mind, let's check out the first scheme, Tax Exemption Scheme for New Startup Companies. As the name suggests, this is a scheme to support new startups. Here's how it works. In the first 3 years of setting up your new startup, 75% of your first $100,000 chargeable income is exempted from having to pay tax. After that, 50% of your next $100,000 chargeable income is exempted. So, for example, on your first $100,000, after the 75% exemption, only $25,000 of your income is subject to the 17% tax. And on your next $100K, after the 50% exemption, only $50,000 is subject to the 17% tax. This means the effective tax rate on your first 200K is just 6.38%. Anything more than 200K, your chargeable income will be taxed on the normal 17% tax. This scheme will automatically be applied to your new startup for the first 3 years. Though, in order to qualify for this scheme, the company needs to be incorporated in Singapore, must be a tax resident in Singapore, and have no more than 20 shareholders for that financial year. All the shareholders must be individuals, and there's at least one shareholder who holds at least 10% stake of the company. Also, your company cannot be primarily an investment holding company and is not in the business of property development for sale or investment. Then, after the first 3 years, or if your company didn't fulfill this eligibility criteria, your company will then be placed under a second scheme called Partial Tax Exemption Scheme for Companies, which is also super generous. Under this scheme, 75% of the first 10K is exempted from tax, and after that, 50% of the next 190K is exempted. This means the effective tax rate on the first 200K will just be 8.29%. Quick pause, starting a business may be difficult, but here's where Osome can help. Osome is a digital business assistant that provides online secretary and accounting services to help you take care of all your company's finance staff, admin staff, remind you to file company reports, and yes, even advise you on the ways you can reduce your corporate taxes. Osome has a useful app where you can manage your payments and invoices all in one place, so that you can spend more time on things that matter, like building your business. So, if you are looking to start your company today, you can check out the link in the description down below to get a free incorporation plus a 16% off your first year with Osome. With that being said, let's get back to the video. Now, even though these schemes are applied automatically, one way to make full use of these schemes is to consider separating your business functions into separate companies, rather than lumping all within the same company. For example, maybe you are running a cafe business and you notice that your cold brews are very popular. In that case, you can spin off a separate business just to specifically sell the drink at retail stores. Or, here's a real-life example. Property Lim Brothers is a realty company that posts their property reviews online. They found success in their social media marketing, so they decided to spin off their media team to a separate agency. Not just that, they also launched Assembly, a training platform to further add value to property investors. This allows you to potentially reduce your taxes while also protecting your businesses from one another. However, with that being said, please do not try to abuse this scheme by setting up shell companies or charging fees from the shell company to an existing profitable company without any real commercial reasons, as IRAS is very strict on tax evasion. Next, if you are like me who only decided to create a startup after the business is proven to be successful, chances are you may have been paying for business expenses out of pocket or even incurred losses prior to setting this up. In that case, you can check out this relief called Loss Carryback Relief. This relief allows companies to carry back unutilized capital allowances and trade losses to reduce the amounts of taxable income in an immediate preceding year. He's speaking the language of gods. To put it simply, if you had losses last year, you can bring forward that loss to this year. Then use this loss to reduce the taxes paid for this year. For example, let's say in 2023, you incurred $100,000 in losses and there's no profit at all. Rather than letting this loss get unutilized, you can carry forward this loss to 2024. Then use it to offset your profits so that your chargeable income can be reduced. Though, take note that the maximum amounts of qualifying deductions that can be carried back is capped at 100k. Next, if you wish to further support your employees while also reducing your company's corporate tax, you can do something called portable medical benefits for your employees. There are 3 options you can choose from. The first option is called the Portable Medical Benefits Scheme. You can use this scheme together with the additional MediSave contribution scheme to top up to $2,730 to your employees' MediSave accounts. This contribution is not subject to the $37,740 CPF annual limit nor the basic healthcare sum limit. This means you can still top up to the MediSave even if they have maxed out both limits. The second option is the Transferable Medical Insurance Scheme, where you buy group hospitalization and surgical insurance for your employees. And the last option is providing a shoe plan to your employees. All these are business expenses that you can use to reduce your corporate tax. And if you do any of this, the medical expenses for your employees will then be raised from the original 1% deduction limit up to 2%. Next, under the Corporate Volunteer Scheme, from 1st July 2016 to 31st December 2026, businesses can claim 250% tax deduction on qualifying expenses when they send employees to do volunteer work, provide services, or are seconded to institutions of public charter. Though, if you are the owner of your business, you cannot send yourself, as owners are excluded from this scheme. So, you have to really send your employees to go psych out, do volunteer work. What's nice is that since 2024, the volunteering activities have also been expanded to include activities which are conducted virtually, like online mentoring or providing tuition support, or conducted outside of the IPC's premises. Though, take note that in order for the expenses to qualify, the volunteer work or service must meet a few requirements. Plus, the qualifying expenditure that you can claim for each IPC is currently capped at $100,000 per calendar year, and the maximum expenditure that a business can claim is capped at $250,000. Moving on, if your business is also earning income from outside of Singapore, chances are you might be possibly taxed in that jurisdiction. In that case, you can claim exemptions under the avoidance of double taxation agreements so that you don't get double taxation. For this, Singapore has agreements with over 100 jurisdictions such as the US, Malaysia, Hong Kong, and so on. Then, last but not least, if your business is doing research and development, you can check out the research and development tax measures. In order to qualify for this, the project needs to either be to acquire new knowledge, create new products or processes, or improve existing products or processes. Though, you can't just create a new kind of mee siam mai ham, then call it R&D. There needs to also be novelty or technical risk, and it needs to involve a systemic, investigative, and experimental study in a field of science and technology. The R&D expenses that you can claim for include in-house R&D, outsourced R&D, or cost-sharing agreement R&D. And in lieu of tax deductions and allowances, eligible businesses may opt to convert up to 100k of the total qualifying expenditure into cash at a conversion rate of 20%. This non-taxable cash payout is capped at 20k from 2024 to 2028. So those were just some of the schemes that a business can use to reduce its corporate income tax. There's a lot more business expenses as well as tax schemes that you can further make use of. Anyway, that's all for this video. Hope you found it useful. Like, share and subscribe as I'll be posting new videos every Monday, Wednesday and Friday.